All right, let's talk about something that affects pretty much every adult in America, the credit score. Now, most of us think we get it, but there's this massive misunderstanding right at the heart of it. Get this, you could have $0 to your name and still be seen as more financially trustworthy than someone with thousands stashed away. How is that even possible? Well, let's dive in and figure it out.
So, let's just start with the most basic question. When you hear that someone has a really high credit score, what's the first thing that pops into your head? Yeah, for most people, the answer is pretty simple. They must be loaded, right? They've got to be rich.
But that is the very first and honestly the biggest myth we need to just completely bust right now. A high score doesn't mean you're rich. It just means you're reliable. That's the key, the one distinction you need to remember. It has nothing to do with how much money you have and everything to do with how you handle money you've borrowed.
And that brings us right into our first section here. We're going to unpack what this number really is. So for a minute, just forget about wealth. Let's think of this as, well, a score of trust. You see, a credit score completely ignores all the stuff we usually think of as financial success. It has absolutely zero to do with your wealth or your income or how smart you are or even how much actual cash you have sitting in the bank. The credit bureaus, they don't look at any of that.
So if it's not any of those things, what does it measure? Well, it's really just one thing, your behavior. Think of it like a numerical grade on how predictable you are. If a lender gives you money, can they count on you? Can they predict with confidence that you're going to pay it back exactly like you agreed to? That's it. That's the whole game.
And this quote right here, it perfectly captures the mindset of the entire financial system. Lenders are playing a game of risk. Their main concern isn't what you have right now. The single most important question they have is about what you did in the past. Your history of paying people back, that's the best crystal ball they have for what you'll do in the future.
Which is why, maybe we should stop calling it a credit score and start thinking of it as a trust score. It's a simple little shift in how you think about it, but it honestly changes everything. The big takeaway here, your score isn't about your assets. It's about your actions.
Okay, let's move on because this next section is where things get really weird. I'm talking about the cash paradox. And this is the part of the American financial system that just feels totally backwards to a lot of us.
So let's picture two people. Let's call them Person A and Person B. Person A is a super diligent saver, has avoided debt their entire life, and they've got a cool $50,000 in cash saved up. Awesome, right? Then you've got Person B. They've juggled all sorts of debt, credit cards, a car loan, you name it. But they have a long, documented history of making every single payment on time.
Okay, now, based on everything we're taught about being good with money, who do you think a bank would rather lend to? The saver with that huge pile of cash, or the borrower with a long history of being in debt? The answer is the borrower. It's crazy, but it's true. Person B, the one who's been using debt all this time, will almost always get better access to loans and much better interest rates than the person who just saved cash. Isn't that wild?
So why? What is going on here? Well, the reason is actually pretty simple. It all comes down to data. Person A, our saver. To the system, they're a ghost. There's no data, no proof that they're trustworthy. But Person B? They've given the system years and years of data points that prove they are a reliable, predictable customer. You see, this system doesn't reward saving. It rewards participation. It rewards a proven track record of using credit and paying it back.
Okay, so why should you even care about this abstract trust score? Because this number has a kind of hidden power that quietly shapes almost every major milestone in your life.
I mean, look at this list. Your credit score affects the really fundamental stuff. Where you can live, what kind of car you can drive, whether you can buy a house. Landlords, car dealers, banks, insurance companies, even some potential employers are using this number to make huge decisions about you. It literally follows you everywhere.
And the impact is just dramatic. A high score doesn't just open doors for you. It makes your entire life fundamentally cheaper. We're talking thousands, even tens of thousands of dollars saved in interest over your lifetime. A low score? It does the exact opposite. It's like a financial penalty that makes everything more expensive, slamming doors shut and limiting your options at every turn. All right, now that we know how high the stakes are, let's do a quick little rapid-fire round. We're going to bust some of the most common and, frankly, most damaging myths out there about credit scores. Okay, myth number 1. This is a classic. You finally pay off an old credit card and you think, awesome, I'm going to close this account and just be done with it. It feels so responsible, right?
But it is absolutely a myth. In fact, doing that can be one of the worst things you do for your score.
And here's why. A big part of your score is based on the average age of all your accounts. So when you close an old one, you're shortening your credit history. It also messes with your credit utilization. That's just a fancy term for how much debt you're carrying compared to your total credit limit. When you close a card, your limit goes down, which can instantly make you look riskier to lenders. And boom, your score drops.
And now for the big one. The one that feels so morally right but is just flat out wrong inside the credit system, this idea that all debt is inherently bad.
This belief is exactly why our saver, person A from earlier, would have such a hard time getting a loan. It's a total myth that being completely debt-free is the ultimate goal for your credit score.
The reality in the American system is that it's just not designed to reward you for avoiding debt. It's designed to reward you for being a reliable customer. A long history of managed debt, where you borrow responsibly and you always pay on time, is infinitely more valuable to the system than having no history at all.
So, after going through all of this, what's the big takeaway? It's really about shifting your mindset from being a passenger to being the driver. It's all about taking back control.
And first things first, let's be super clear. This number is not a measure of your value as a human being. It is not a reflection of your intelligence, your character, or how successful you are in life.
It's simply a record of your borrowing behavior. That's it. It's a trust score used by lenders. It's a tool. And like any tool, once you understand it, you can use it to your advantage.
And that right there is the most crucial point of all. This isn't some mysterious force that just dictates your life. Once you understand the rules of the game, that it's all about reliability, not riches, you're the one with the power. You can make this system work for you instead of the other way around. The score stops being something that just happens to you, and it becomes something you actively manage and control.